Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500 and most importantly on its relationship with crude oil. I want to take a look at this chart in particular in this video that shows us that a surge in energy prices, so crude oil prices, increases the probability of a recession. Every time you get a rise in the price of crude oil, it triggers a recession, and along with it, very often, a bear market. So we're going to talk about that in this video. Now, if you've been following our analysis for quite some time now, for the past few weeks, we've been studying this correction here very closely, and based on the research and analysis that we've made, this is a late cycle correction. We've had one of the shortest economic booms in history since 2020 here. This was an artificial, very rapid economic boom where central banks prevented a recession from happening and created an economic boom, as opposed to what usually happens, which is a recession occurs and then they step in with easy monetary policy. Here, they did it within the matter of weeks to stop a recession from happening during a pandemic. So we've had this economic boom and we're getting into the later part of that boom. But if we check out previous cycles, and this was a previous cycle right here, this was the later part of the 2009 to 2020 economic boom. Stock market returns were massive. In the later part of this economic boom here, stock market returns were massive. In the later part of this economic boom, stock market returns were absolutely massive. So we don't want to get bearish too quickly. That is a big mistake that a lot of investors make, and they end up buying back in at the top when it's time to be exiting in a big way. So we're going to see in this video how crude oil prices fit into that thesis. Now, without further ado, let's get right into it. Before we get into this video, I just quickly want to say a big thank you for all the amazing comments that we had in the last video. A huge number of you came out and showed your appreciation for the content. It really is always great to see that. By the way, if you do enjoy this video, do not forget to smash that like button as hard as you can. Now, let's take a look at this surge in energy prices. How do they calculate it? Is it really correlated to recessions? And is that something that applies today? This chart shows you the percentage deviation of crude oil prices from their trend. And it basically says every time you hit a certain deviation from the trend, it triggers a recession. So before just taking this information blindly, I wanted to check out using my own indicators how this data actually looks by making my own charts on the percentage deviation from the trend. And so the way I do that is by putting this indicator on this chart of crude oil prices. This is a weekly chart of crude oil prices going back to the late 80s. And we have this indicator that tells us the percentage difference between the price and the 100 period moving average. And in this case, it's a weekly chart, so it's the 100 week moving average. And I'm going to put that moving average on this chart so we can actually visualize what this data means. What it basically tells us is when the price is a lot higher than that moving average, you get a big reading on that indicator. When it's a lot lower, well, you get a very low reading on that indicator. And so you can see here, we're clearly very, very overextended relative to that 100-week moving average. And clearly it's showing a nice big reading on this indicator. And you can see that past readings on this indicator were 2008, 2004, right here. You did have a big spike here in 2004. 1999 right here. And then the year 1990. Here there was a recession. Here there was a recession. Here there was no recessions. Obviously was a recession in 2008. So yeah, this chart is pretty accurate. The only comment I have on this data is that in 2004, my indicator shows that the trend was really overextended. So I don't know exactly how they calculated this. What you cannot forget with this type of chart is that they often manipulate the data to leave out whipsaw signals, right? And clearly 2004 was a big deviation from the trend, but it didn't cause a recession, and so it didn't make the data look perfect like it is on this chart. Nothing is as perfect as this. Clearly what is happening here is going to have an impact on economic activity as crude oil becomes more expensive. Pretty much everything becomes expensive, and so that lowers demand. And so that does fit in very well with the fact where this is the later part of the economic cycle. But you do have to put this data into perspective that it's not necessarily going to have an impact straight away, right? It can take months, if not sometimes years, before recession plays out. Here we have that overextension reading in very early 2000. The recession didn't actually occur till 2001. Here, throughout this entire period, crude oil performed extremely well. We had multiple readings of overextension that didn't lead to a recession until much later on. But this is definitely going to be a big headwind to the economy. And that flattening yield curve that we've been talking about, right? That big recession predictor that, a lot of people look at, it's very unlikely that it's not going to go into inversion with crude oil prices this high. Elevated crude oil prices like that is pretty much the typical thing that can lead us into a recession, right? In 2005, 2006, rising crude oil prices led us into a recession. That, of course, only played out after the inversion occurred, right? So, we're in this part of the cycle here. Although it's happening a lot quicker, we're not yet in a post-inversion market environment. And just to give you guys all the data, I want to quickly cover this chart here from Fundstrat that shows gasoline spending as percentage of the wallet, the average wallet. It gives you where we currently are. It's around 2.5% of total wallet. And it gives you projections. If we go to $200 oil, that's going to be 4% of the wallet. And that's still lower than where we were at right before the great financial crisis. Now, we're not putting too much weight on this because surging oil prices isn't just reflected on gasoline prices. It has a variety of impacts across so many different products and services that just puts pressure on the individual spending. But it's not just oil, it's all commodities that have been rising lately. And so when all commodities rise, the price of chicken is rising, the price of beef is rising, wheat, soybeans, corn, everything is rising. And so that is going to have the same impact, which is slowing economic activity and leading us into a recession. So we are getting into that part of the cycle. But as I said at the beginning of this video, and this is probably going to be a very contrarian opinion, stock market returns in this later part of the cycle can be exceptional if you're buying the dip. Now, of course, if you bought at the very top, stock market returns aren't going to be that exceptional. Same thing here, right? You bought at the top in September 2018, stock market returns late cycle aren't good. But with volatility comes opportunities, and I can tell you that people who bought the dip right here in this late cycle correction in 2018 had tremendous performance throughout the rest of the cycle. That's a 25% run, even further if you count 2020. Now, right now on the website, we have a ton of articles and videos that we're putting out talking about this late cycle rally, how we're preparing for it, what sectors we think are going to perform well, why it's going to happen, and most importantly, when. One of the big triggers that we're watching out for is peak inflation. CPI is currently at 7.9%. It's going to be even hotter likely in March. But looking out April and May, CPI is going to start to come down, and that's going to be very good for the market. So perhaps a little bit more volatility until then, and then a nice broad recovery as we get that peak inflation narrative in the market in this late part of the cycle. If we take a look at the put call ratio here, it's incredibly elevated. There's a lot of bearish sentiment in the market right now, a lot of space to move back down into a more complacent market. There's a lot of fear right now. And so that puts the short-term risk reward as pretty favorable in the market. Now, again, could we see more volatility? Absolutely. But I think that volatility, if we do see more volatility, it could end up being a nice buying opportunity. Now, of course, we'll be updating that every step of the way. Do not forget to smash that subscribe button if you're interested in following these market updates with us, following these crazy markets every step of the way. And if you want more top-notch analysis, top-notch trade ideas, investment ideas, actually learn what's going on in the market and stay up to date on all the data, all the news that there is, make sure to click on the link down below and check out our service at gameoftrades.net. Now, that's about all I wanted to cover in this episode. If you enjoyed, smash the like button, subscribe. Now, in the meantime, I wish you good luck on your trading and see you next time.